Something is rebalancing the global oil market. It is not a ceasefire. It is not a pipeline bypass. It is not the US releasing its strategic reserve. It is China. Quietly, without a single announcement, without emergency measures, without a single headline, China has withdrawn 3.2 million barrels a day of crude imports from global seaborne markets. And in doing so, it has revealed something deeply uncomfortable about the oil demand numbers the world has been relying on for the past 3 years. Let me give you the numbers first. Before the Strait of Hormuz closed on February 28th, China was importing 11.2 million barrels of crude per day from seaborne sources. By April, 8 weeks later, that figure had collapsed to 8 million barrels a day, a reduction of 3.2 million barrels a day. 3.2 million barrels a day is the entire oil consumption of Japan. It is double the volume of the UAE pipeline that bypasses Hormuz at full capacity. As Bloomberg Opinions, Javier Blas, wrote on May 8th, China's import swing is perhaps the second or third largest factor rebalancing the oil market today, behind only the Hormuz supply removal itself. This chart shows China's seaborne crude imports from January 2025 through to today, steady at around 11 million barrels a day through 2025, a slight uptick in early 2026 as the war approached. Then, the moment Hormuz closes, a steep, sustained collapse. 8 million barrels a day in April, 6 million in May, partial data, still falling. What makes this extraordinary is what did not happen as a result. Chinese refineries kept running. Commercial inventories kept rising. No rationing, no emergency announcements. The country absorbed the equivalent of Japan's entire oil consumption, disappearing from its import bill and barely noticed. The explanation is the stockpile. China holds approximately 1.4 billion barrels in its strategic petroleum reserve. That is more than 3 times the US Strategic Petroleum Reserve, more than 5 times Japan's emergency stockpile, the largest national crude reserve on Earth by a considerable margin, and almost none of it is visible. The USSPR is stored in known salt caverns in Louisiana and Texas. Audited, published weekly, every barrel accounted for. China's reserve is stored partly in commercial tanks that satellites can track, and partly in underground rock caverns and military facilities that no satellite can penetrate. The 1.4 billion barrel figure is an estimate, derived by tracking tanker flows into Chinese ports over years, subtracting consumption, and accumulating the residual. It is not a published number, it is an inference. This opacity is not accidental, it is the tool. The market cannot price how long China can sustain its drawdown or when it will end. That uncertainty is itself strategically valuable. Here is where the widely cited figures mislead. You will have seen reports saying China has 7 months of Hormuz import cover. That figure assumes China draws its reserve at full pre-war consumption rates, which overstates the required drawdown significantly. The correct calculation is this. China's domestic production continues at 4.3 million barrels a day. Pipeline imports from Russia and Central Asia continue at around 0.7. Only the seaborne import gap of 3.2 million barrels a day actually needs to come from the reserve. At 3.2 million barrels a day, 1.4 billion barrels provides a runway of over 14 months. And in the current reduced runs environment, with refineries processing less, that runway extends further still. Here is the analogy that makes sense of what China is doing. When a central bank wants to stabilize a currency under pressure, it sells its foreign exchange reserves, absorbing buying pressure, reducing volatility, capping the price spike. China is doing something structurally identical in the oil market, but in reverse. Rather than selling reserves to cap prices, it is using its reserves to suppress demand for seaborne crude, which has the same price dampening effect. By drawing down its strategic reserve instead of buying from the market, China is removing 3.2 million barrels a day of buying pressure from global markets. That is what is keeping oil near $100 rather than $150. The physical market evidence is unmistakable. Javier Blas reported that Chinese state oil companies, Sinopec, CNOOC, PetroChina, have been reselling cargoes to European and Asian rivals. Barrels that in early April went for $30 above benchmark prices are now changing hands at premiums as low as $1. Talk of discounts has even started to emerge. China is not a passive victim of the supply shock. It is an active market participant managing inventory, and the rest of the world is pricing oil against a policy decision being made in Beijing that it cannot observe directly. This brings us to the most important question, one that predates February 28th entirely. Was global oil demand always smaller than we thought? Here is how oil demand gets measured. It is not measured directly. It is derived residually. Production plus net imports minus observed stock changes equals demand. The problem is that stock changes are the hardest variable to measure accurately, especially in China, where the strategic reserve is invisible to satellites and unaudited by any international body. When China was building its reserve at approximately 1 million barrels a day in 2023 and 2024, that 1 million barrels a day did not appear as a stock build in any model that analysts could see. It appeared as demand. The data reveals something that was hiding in plain sight. Look at Q4 2025. October alone showed a global supply surplus of over 3,500,000 barrels a day. The market was already softening before a single shot was fired. This was the China build reversal beginning. Beijing quietly stopped adding to its reserve in the second half of 2025. Demand metrics started softening. The structural imbalance was already emerging. The Hormuz crisis then masked what would have been a visible demand reckoning regardless. The waterfall chart tells the decomposition story clearly. The 8,200 kbd apparent demand decline between pre-war average and April 2026 came from three places. The Hormuz supply removal, the largest single factor. China's import reduction, accounting for approximately 39% of the total apparent drop. And other demand destruction, the smallest contributor. Strip out the reserve-building artifact. Account for China's EV transition, its fleet now as large as the rest of the world's combined, displacing roughly as much oil in 2025 as China imported from Saudi Arabia. Factor in the coal-to-chemicals shift in Chinese petrochemicals. The honest demand figure for a post-crisis normalized world is likely closer to 83 to 84 million barrels a day, not the 85 to 86 that Q3 2025 peak figures suggested. The one counterweight, precautionary stockpiling. Japan, South Korea, India. They watched China weather this crisis from a position of strength they did not share. They will seek reserves of their own. That precautionary buying is the most plausible source of upside surprise in any post-crisis demand recovery. 4 things to watch. Signal 1. China's weekly seaborne import trend. May partial is near 6 million barrels a day, still falling. The first confirmed weekly print above 9 million would signal China is restocking, not drawing down. That inflection is the most important data point in the oil market right now. Signal 2. Chinese state oil company cargo resales. When Sinopec, CNOOC, and PetroChina stop reselling cargoes and return as net buyers in the physical spot market, the drawdown phase is over. This will be visible in cargo markets before official statistics confirm it. Signal 3. The drawdown runway clock. 14 months from the start of the crisis places the theoretical inflection in late April 2027. The race between geopolitical resolution and China's reserve runway is the structural clock nobody is watching closely enough. Signal 4. Trump's Beijing visit. 2 channels matter: Iranian sanctions enforcement and bilateral energy agreements. A US-China understanding on Iranian crude would tighten China's cheapest supply source and force it back into the seaborne market as a buyer. The absence of any deal is also a signal. China retains full independence, which is bearish for prices. Javier Blas ended his piece with a question that every oil bull should sit with. If the country can reduce imports so drastically without apparently having to take extreme measures. What does that say about the future of oil consumption there? Nothing positive for the bulls. Full analysis in issue 4 of the Crude Oil Desk newsletter. Free edition at crudeoildesk.com. Every week. Subscribe, hit the bell. See you next week.